Welcome, everyone. Today, we'll be diving into the world of business valuation. Specifically, breaking down the essential methods you need to know to understand how companies are valued. No matter if you're an entrepreneur, investor, or just curious about corporate finance, this session will pave the way for confident decision-making. Let's get started on discovering how businesses calculate their true worth. Before we jump in, here's our roadmap for today's session. We'll begin with a quick introduction to business valuation and why it matters. Then we'll move through the three main types of valuation approaches: income-based, market-based, and asset-based methods. Afterward, we'll discuss how to refine these valuations with adjustments and wrap up with best practices and key takeaways. Stay tuned to gain a comprehensive understanding from start to finish. Let's begin with the basics. What is business valuation and why is it so crucial? In essence, business valuation is a process, a mix of procedures and techniques, used to estimate the economic value of ownership in a company. Getting an accurate valuation isn't just a financial exercise. It's essential for mergers, acquisitions, divestitures, tax calculations, litigation, and major investment decisions. Every valuation approach falls into one of three primary categories: income-based, market-based, or asset-based. Which method you choose depends on the company's structure, the reason for the valuation, and the kind of data available. This foundational choice shapes the entire analysis. Now, let's explore the first main approach: income-based valuation. These methods aim to forecast future profitability and discount it back to present value. But there's more to it than just crunching numbers. Accurate forecasting and sensitivity to risk are key. Risk and scenario. It starts with analyzing risks and outlining scenarios. This means forecasting not just the most likely outcome, but accounting for industry trends, growth prospects, and any uncertainties. Communicating those risks to investors is essential for credibility. A capitalization of earnings. For companies with stable, predictable profits, capitalization of earnings estimates sustainable future returns. By applying a rate that factors in both risk and expected return, this method paints a clear picture for investors. Discounted cash flow. Probably the best-known method, discounted cash flow, or DCF, calculates present value based on expected future cash flows. Getting this right depends on solid forecasting and smart risk adjustments. Businesses rely on DCF because it is so versatile and precise. As we transition, remember, income-based approaches focus on the company's ability to generate returns over time, making them powerful but highly dependent on accurate projections. Switching gears, let's look at market-based approaches, which tap into benchmarking and comparables. Sector fit. These tools work best for companies in active sectors, where there are plenty of comparable businesses to use as reference points. But if a company has uniquely structured operations or lacks data, applying market methods can be challenging. Comparable update. Because markets move quickly, it's crucial to update your set of comparable companies regularly. Old data can lead to inaccurate results. The multiples you use, like price to earnings or revenue ratios, should reflect the current market mood and risks faced by businesses. A guideline transactions. Here, you'll search for similar companies that have recently been acquired or listed. Guideline public company and transaction methods use actual deals, either from public markets or private mergers, to establish valuation benchmarks. Market valuation, then, is all about using what's happening right now in the industry to illuminate the worth of your target company. Next, let's see how asset-based methods bring balance. Asset-based methods provide a more direct approach by focusing on the company's tangible and intangible assets. Book value. This is the straightforward sum of all asset values listed on the balance sheet, minus liabilities. It works well for companies that hold valuable physical assets. Adjusted net assets. Take the book value and adjust it for market prices or fair value, also making changes for depreciation, impairment, or other relevant updates. Liquidation. Thinking worst-case scenario? Liquidation value estimates what could be recovered from selling off assets and paying liabilities in situations like reorganizations or distressed sales. Intangible. Don't overlook non-physical assets. These include brand reputation, intellectual property, and goodwill. Estimating value here is more subjective and often relies on market benchmarks. These approaches are most effective when asset values are key drivers of a company's overall worth. Now let's see how to refine any method for greater accuracy. Valuation adjustments help tailor and fine-tune foundational methods so that final values better reflect reality. A market. When valuing minority stakes, discounts may be necessary to account for reduced control and marketability in private sales. Premium. Conversely, control premiums boost value when a buyer gains authority, commonly seen in M&A and major stake deals. Transparent, well-documented calculations are critical. Timing. Timing discounts come into play when liquidity or access to capital is constrained. Experienced appraisers must consider deal structures and exit plans carefully. Taxes. Changes in tax law, whether capital gains, estate, or transfer taxes, can seriously affect your valuation. Make sure all tax effects are modeled and disclosed clearly. So, adjustments sharpen the relevance and comparability of your valuation, helping align it with actual market conditions. Quality reporting and compliance with standards are the backbone of reliable valuations. 3 pillars support this process. Documentation. Keep detailed records of every assumption, calculation, and data source. A thorough audit trail not only boosts credibility but also helps clarify misunderstandings later. A standards alignment. Adhering to accounting, legal, and tax standards, think AICPA, IFRS, IRS, ensures consistency. This builds confidence among stakeholders and stands up to regulatory scrutiny. Audit/approval. Peer reviews and professional validation add an extra layer of independence and objectivity. In formal opinions and regulatory filings, this step helps solidify your findings and reputation. Careful documentation and independent review ensure that your valuation withstands even the toughest questions. As we wrap up, let's highlight the top best practices that underpin successful valuations. Stay current on regulatory changes. Always support your valuation opinions with the most up-to-date data and defendable methods. Report clearly, document thoroughly. Ensure all risks and adjustments are transparently reflected in your reporting. Integrate adjustments for accuracy. Select the right adjustments based on company size, industry, and reason for valuation. Understand each method's use case. Remember, business valuation blends rigorous financial analysis with sound professional judgment to guide big decisions for leaders and stakeholders. Thank you for joining this exploration of business valuation methods. Apply these insights to drive clearer, more strategic decisions in your professional journey.